got a handout that says Chapter 1 handout definitions. And it looks like this. And there's a lot here. One of the strange things about accounting, well, accounting is 400 years old. So, or even, the type of accounting we're using is about 400 years old, maybe even more. But so there are things that have evolved through the years that people use for, naming accounts and all that sort of thing. And in accounting, we don't really have, you can name accounts almost anything you want. But the type of account makes a difference. So a lot of times you'll see the same account called different things, even though it usually, fits into a category. And there really only are 5 categories in accounting, which we'll talk about here. It's revenues, expenses from the income statement, and then assets, liabilities, and equity from the balance sheet. And all the craziest transactions you can imagine, they all come from those. And basically accounting is, if you do something, in accounting, if you do something in your business, I should say. So if you buy inventory, you want to write that down, right? You put it into an account. You say, okay, we bought inventory. We bought $500 of inventory, whatever it is. You put that into an account. If you make a sale, you're going to write that down. You say, okay, we made a sale of $30. We sold this, whatever, to, So it really is just kind of keeping track. So when we talk about these accounts, the accounts themselves are just lists of numbers of what transaction actually happened. What did we actually do? Bought inventory, bought a piece of equipment, sold something, paid a bill. Those are all just things that you just kind of you're going to write down and keep track of. So we talk about these accounts. We're just talking about these accounts that they're going to be basically sort of like lists of pluses and minuses. Cash came in, cash went out, that sort of thing. Okay, so from our handout last class, we have revenues. Okay, question?
Why don't they just if it means the same thing, why don't they just call it one thing?
That's
confusing.
Well, you got to remember too, though, there's companies that have been using the same account for 100 years. And you have another company that's been using a different account for 100 years. So you have these two, and companies generally don't like to change their, the way they do things. For one thing, they don't want it to be confusing. They don't want someone comparing one year to the next. And if there's different accounts, they'll say, well, what is this? Most of them are kind of very much standardized, though, but they can call them different things, and it is confusing. I agree. For instance, the revenues account. Let's go ahead and get started on this one. The revenues account is just money earned from customers. They haven't necessarily paid us yet, but if we've earned our money, if we earn the money, they may have an accounts. We may have accounts receivable, which we'll talk about later, that they owe us money. They just haven't paid us yet. So revenues is the general account that, and most companies use it. Probably about half the companies use the term just revenues. Money coming in. What do we earn from our customers? So if we're, selling hamburgers, how much do we make? How much do we make selling the hamburgers? What money came in from the hamburgers? If you're selling cars, what money came in from selling the cars? It's just money coming in. And revenues are sometimes called earned revenues. They could be selling goods or services. It could be either one. You could be selling hamburgers. You could also be selling services. Comcast, they sell services. They make their money by selling services. So revenues could be it really are any way that you make money from your customers. Earned revenues are the same thing as revenues. Basically, all revenue is earned. So revenues and earned revenues are really exactly the same thing. Sales are used interchangeably with revenues. Usually it's for selling goods, but it could be for selling services too. They have service sales and all that kind of stuff. So sales and revenues are the two accounts you'll see the most often. Sales and revenues. Revenues probably used a little bit more, but sales used a lot interchangeably. So some companies, you might have IBM that uses the term revenues, and maybe you have General Motors that uses the term sales. It's exactly the same thing. Usually sales means that they're selling goods, but not always. And some of the ones that are less descriptive, you may have service revenues or repair revenues. If you're doing repairs for, you run an auto shop, you do repairs. You make money doing the repairs, but you also make money maybe selling things. So you may want to keep them separate. And these are the kind of weird ones down here. These are the ones you don't see very often. Fees earned, commissions earned. Generally speaking, if you see something that says earned, it's usually a revenue. So that's kind of a magic word. So whenever you see earned revenue, because you earn the money. And again, when we count revenues, the defining factor is when we earn it, not necessarily when we get paid. So if I mow my neighbor's yard, I say, I'll mow your yard for $20. I mow the yard, but my neighbor hasn't paid me yet. I count it as a revenue because I've done my part of the work. So my neighbor owes me $20. So we always count it when it's earned, not necessarily when the cash comes in, which is a little bit different than what most people think about a business. But that's really what we do. It's the type of accounting that we do is focused on when we earn revenues, not necessarily when the cash comes in. Okay. Let's go down here to expenses and costs. Okay. This is money or goods going out of the business. So expenses and costs is money going out. So revenues, it's coming in. Expenses and costs is going out. Just like your expenses, you work your job, money comes in. You pay your rent, money goes out. Same thing. Okay, so expenses and costs is generally either cash going out or their goods going out. Okay, so let's jump into these. These get a little bit, the first couple here are a little bit wacky. Cost of goods sold. And these are goods that were sold to customers. These are goods that are leaving the place. So, cost of, I lost my toy. Okay. Okay, so let's say I'm selling toys. This is a toy. So let's say it's a toy. So this is here's my toy. I have my shop and I sell it. Now, let's stop that. Notice though, so I have this. I bought this. It's an asset. Now, when I sell it, it goes. Whoever bought it takes it with them. That's what cost of goods sold is. Whatever I paid for this, it's leaving. So I'm not really losing cash when I say that talk about cost of goods sold. When I usually use what I'm losing is whatever the item is I sold, the inventory. So this toy is no longer in my shop. It's left, someone bought it and took it with them. So cost of goods sold is actually the goods that are leaving the place. It's not usually cash that's going out, it's the goods themselves. So
why wouldn't Why wouldn't that be considered like revenue? Because aren't you getting paid for that item that's leaving your shop or whatever your service is?
You're exactly right. There will be a revenue. Right, so here, let's make it a more concrete example. Let's say that we sold this thing for oh, I don't know, let's make up the number. $20. So we sold it for $20, but maybe the cost of it was let's make up a number 12. Okay, so you may very well have that I sold it for $20. So $20 would be the revenue. My cost of it was 12, right?
Right,
So-
the cost of how much it costs you to get the item in your possession, right?
That's exactly right. Yeah. So what did it cost to get for me to get this into my shop? $12. Now, you know, how much money did I make on this thing? On this sale?
$8.
$8.
Yeah, that made $8. Now, so I'm going to record the $20 came in because they handed me a $20 bill and when they came in the shop. So I got $20. I paid $12, so I lost this. This is leaving the place. So I really made $8 on the thing, but this is how you would actually keep track of it. You say, okay, $20 came in. Some goods that I had that cost $12 went out. And later we'll find out that that'll go into your income. You know, it'll be how much income did you make on this thing? You made $8. That's how much profit you made on it. Again, this is a weird, we're just kind of, accounting is almost like a language, almost like putting it into kind of like formally putting it into something that's kind of intuitive. It's intuitive. I didn't have to tell anybody in here that if you buy something for $12 and you sell it for $20, you made $8. You guys knew that before you ever came in here. This is just kind of a way of standardizing how we account for it. Okay. So yeah, so this is the goods that are actually leaving the place will be whatever we paid for. Cost of sales is the same thing as cost of goods sold. Many companies will use the term cost of sales. For large companies, they use this more often than they use cost of goods sold. Okay, so this is they're interchangeable. Okay, now supplies expense is a little bit different in that when we buy supplies, what we're talking about here is things that we're not selling. So maybe you have cleaning supplies for the place. So I have my shop. We clean it. I have cleaning supplies. I'm not selling cleaning supplies to the customers. They're coming in to buy the toys, but I need the cleaning supplies. So the cleaning supplies, as they're used, they're expensed. So I might buy, a bunch of cleaning supplies. When I first buy them, they're going to be an asset. As I use them, they get expensed. But again, this is a little bit different than cost of goods sold in that the customers aren't buying these. There's no revenue attached to that. When I clean the counter, no one pays me. So it's money going out. Okay, and expenses are really anything basically that you pay money for as a business. And I realized I left one off here that I thought I had in. Tax expense. But anyway, same, you guys get the idea. So advertising expense, it's cost of advertising. Insurance expense, cost of insurance, embarrassment, so on and so forth. Salaries, what you paid your employees, salaries expense. Wages expense. If some employees are paid wages, some are paid salaries, so you separate one. You can also, sometimes these are used interchangeably also. So, expenses are basically the cost of running a business. So the cost incurred to operate a business, that's what we're talking about here. We talk about expenses and costs, and you know, that these are all those things that you would need to run a business. Rent, pay your employees, all that kind of stuff. So this is money coming in, revenue's coming in, expenses are going out. And what's left over is your net income. And again, this is not a foreign concept to anybody here. Everybody here knows that, you know, to make money, if you're in a business, more money needs to come in than goes out. That's so this net income is, again, it's sort of a formal way. All right. Now, net income is not always called net income when you look at these companies' financial statements. Net income is probably used about, I don't know, half the time. And earnings or net earnings are used probably the other half. So a lot of companies will call them earnings instead of income. Same thing. So earnings and income are the same thing. When you think about our accounts, we talk about retained earnings. Retained earnings are just retained income. It's just what the company has made but hasn't paid out to the owners yet. Dividends is a transaction with the owners. It's paying the owners from the company. It's money going out, but it is not to run the business. It's to pay the owners. And you can run businesses without paying dividends. You can say we have a bad year, we're not paying dividends. For years, McDonald's never paid a dividend because they were growing so fast that you know that it was better for them to keep the money and make 20% on it rather than pay it out to the shareholders who would then put it in the bank and earn 2% or something. So for years, they didn't pay out dividends. Okay. Assets. This gets confusing. Assets are anything that has a future value. Okay, cash obviously has a value. Okay, accounts receivable. This is what actually this is in the problem too, I think, in the handout. It was one of the new set of accounts. Accounts receivable is when somebody owes us money or owes the business money. And this comes about from when a customer buys something. It could be we did a service. Like if I mowed my neighbor's lawn, he hasn't paid me. It's an accounts receivable. Now, notice there's a future value that when it's paid in cash, cash has a value. So accounts receivable is when somebody owes the business. And when they owe the business, then it's an accounts receivable that you expect to collect it. You know, this is small to me for some reason. Hold on a second. A little bit more readable. Okay. Inventory and merchandise are the same thing, and that's the inventory that you plan on buying to customers. So if I was running a toy shop, if I bought this to sell to a customer, this would be an inventory or merchandise. So when I bought it for $12, I'd write down I got a $12 whatever this thing. So that's your inventory. That's to be sold to customers. All right. Supplies, these are, glass cleaner or whatever, things that I have to keep the shop going. I don't sell these to the customers. I don't sell glass cleaner. I sell toys, but and as I use these up, I expense them. But when I first buy them, they go into a supplies account. Okay, wacky items. Not so wacky, but if you prepay something, if you pay something ahead of time, it's counted as an asset. So if you pay for something before you use it, it's considered an asset. The two most common things for that are rent and insurance. Generally, you have to pay rent ahead of time. So if I pay rent, if you put a deposit down or whatever, and you pay rent ahead of time, we count that as an asset. And same thing with insurance. Usually pay insurance ahead of time. So rent and insurance are probably the two most common ones. There could be other things too, though. Subscriptions and things like that you pay ahead of time. Those are all considered prepaid. If you pay for something, annually, that I like to pay for my whatever bill annually. That's considered a prepaid, and it's an asset. And insurance, something like insurance too. If you cancel the insurance, generally you're owed whatever is left over on that insurance. So it actually can be turned into cash also. Any questions on that? So prepaid are things that are paid ahead of time, and they have a value because we're going to use them in the future. Okay. Land, building, equipment. These are the most visible things you'll see in a company. When you look at a Walmart, big parking lot, they have a big building, that's land and building, and inside of the equipment. So land is just land, real estate, property. Buildings are separate from the land. So buildings, factory, plant, warehouse, whatever building is there, garage, those are all buildings that are on land. And if you're wondering why we separate them for a reason that we're not going to talk about until we get to chapter 3. And that is, we keep them separate. The land underneath the building is going to last forever, or the foreseeable future. The building probably won't. At some point, buildings become too old to keep up, and they tear it down, put up a new one. So the land underneath it, we keep it up forever. The building will depreciate. We'll say, okay, this building is not going to last forever, so we'll plan for that. And by the way, when you buy land, or when you buy a house, basically you're buying the land, and oh, by the way, it comes with this house that's on top of it. So usually when you're talking about buying a house, you're talking about the deed for the land that, by the way, the house that's on top of it comes with it. And you can actually separate those. It's hardly ever done, but for larger buildings, you can. When I worked at Robert Morris College, we were trying to rent a building, and we got the people that own the building would rent it to us. There were separate people that own the land underneath, and we could get a deal with them to rent it to us. So they had separated the building and the land were two separate things. You don't see, for most, like buying a house, you're not going to see that, but it is possible to do it though. And equipment is just basically long-term stuff, equipment, trucks, cars, all that kind of stuff, airplanes, those are all equipment. We also have some strange ones that are what they call intangible. Two of the more visible ones are patents and copyrights. And patents is right to use an idea. Drug companies will have billions of dollars of patents. Look at a drug company, if you look at their financial statements, they'll have billions, and they're intangible. The value is not in the patent. You say, well, okay, well, wait, I can touch it. There's a piece of paper here that has a pen on it, but the value is not in the paper. The value is for them is to be able to sell this drug to people, and they have the exclusive rights to sell it. So it depends. And copyright, same thing. Software companies, huge amount in copyrights. They have the right to use this software that they develop. Music, the music business or entertainment business, copyrights. Those are the big money makers. Okay. Question on that? Okay, and again, I know this is this is a lot. One thing about accounting that I would tell you though is if you do go into accounting, you learn a lot about business because you have to record all these transactions from every place. The marketing department, you'll know how to do the transactions for them. Purchasing department, you know how to do the transactions for them. All the banking stuff, you know how to do those transactions, and you have to understand those transactions to do that. So you actually learn quite a bit about business and how it operates, if you go into accounting. Okay, payables, you'll notice something here. There's a common thread here to payables, and that is you owe something to somebody else. So all these payables and liabilities is what you owe to lenders or customers. So basically anything that's a payable is going to be a liability. And whatever salaries payable. If you're running a business and you have employees working for you, a lot of times they'll work and then you get paid, maybe you get paid at the end of the week, right? Well, while they're working, you owe them money. So you will actually owe your employees money until you pay them for their salary or their wages. So it could be that you owe your own employees money. You'll have a payable to employees. Okay, time for the wacky ones. Unearned revenue. This is when a customer pays you ahead of time. So my neighbor wants me to mow the lawn. He said, I'll pay you $20 to mow the lawn. I said, okay, that's great. And he hands me $20. He said, okay, here, I'll pay you the $20 right now. And I go, okay. So now here's the weird thing. I got the cash before I've actually done anything. Now, if I don't mow my neighbor's lawn, I got to give him the $20 back. That's the liability. So the liability for unearned revenue is when someone pays us ahead of time. Unearned revenue is sort of misleading. It's really not a revenue at all. It's a liability. And that they've given us the money, but I haven't earned it yet. And if I don't earn it, I got to give them the money back. So if I can't mow his lawn, I got to give them $20 back. So it's a liability. Customer deposits are exactly the same thing as unearned revenue. It's money that is not earned. Okay. The equity account is simply the owner's share of the business, owner's share of the assets, basically. So common stock, it's sold to investors. They become owners at that point. So a company will have their stock printed up and be sold to owners, or investors, I should say, that become owners at that point. And the owners may work in the place, they may not work in the place. Additional paid in capital is a goofy account. I don't want to get into, but I guess I have to. There's a weird thing that sometimes there's a minimum amount that the stock must be sold for. So if it's got a par value of say $10, anything in addition to $10 goes into additional paid in capital. It's a goofy way of doing it. This is one of those things I wish would go away, but I don't think it is.
Can I ask you something?
Yeah.
Like, I was like doing research about option stocks, different things like that.
Yeah.
They would talk about how the stock owner could decide to exercise the right of being able to take or like being able to basically say that they want their shares back. You know what I'm talking about?
Yeah. I actually, one of the jobs I did after I graduated accounting is I went to the CBO, which is the Chicago, the options exchange in Chicago Board of Options Exchange. I actually worked on doing options. My bachelor's degree was in finance, but yeah, you can do a lot with options and stocks. We're not going to get into this class, but you can actually create fictitious stocks with But you know what you're doing with options. You can actually create an IBM stock, say, without ever having an IBM stock, without ever buying it from IBM. But yeah, there's definitely things that you can do with these with stocks, buying ownership of companies and having the option to buy out. Just for the record, it was excruciatingly boring. I thought it'd be real exciting. Options exchange, wow, this would be great. But you end up staring at a computer monitor like really intensely for 8 hours a day. So anyway, but yeah, I used to work in the options exchange. Well, they probably aren't open now. We used to be able to go visit them, the options exchange. I kind of doubt they're doing it live now, but it'll be interesting looking at it. It was really kind of neat in Chicago though, because if we were in Chicago, the Chicago Board of Options Exchange is literally like 6 blocks away, I think. So, okay. So anyway, these are just kind of some of the, and by the way, when I went to the options exchange, they even though it wasn't the job wasn't about accounting, they used to hire a lot of accountants because the accountants generally are good at math. So if you were an accountant, they really wanted you to come join them. Even more so than, I'll put it this way, about 20% of the people I worked with were not doing accounting, but they were CPAs. Okay. So anyway, this is and again, it's just kind of getting used to the naming, the nomenclature, whatever, of all this stuff. It's kind of, and it's hard because and if it does seem strange, it should. Mostly this is the first time you're seeing it. So being dropped right in the middle of it can be kind of tough. But yeah, so this, and as we go through this, hopefully it'll make more sense. Okay, any questions?
Yeah. Will this version of like the stuff that you highlighted and wrote in be on Blackboard? So like
I can post on that. I have no problem doing that.
okay, yeah, just so to like look at and stuff.
Yeah. And again, this is one of those things that you can probably keep this, keep this handy as we go through. That if I throw out an account or something that doesn't make any sense, you can look it up on here. Most of the accounts that we're going to be doing are included in this.
Is there going to be somewhere like we can turn in our assignment?
Yeah, we're going to do that today, and I'll go through that. I'll go through that next. So next thing we're going to do though is finish save this, and I will write down to post the definitions. Now the blank version of this is already in Blackboard. Make sure I'm not lying to you. Yeah, so the chapter 1 handout definitions are already in there, but I will post this one also, the highlighted one.
Thank you.
Okay, so let's go to, nope, not you. Nope, not you. Let me clean this up a little bit here. Okay, so this is what we had from last class. Spacing. Okay, so that's the problem we did last class. This is for this class, and hopefully you got a chance to take a look at it. There's a famous saying that it's actually Socrates, that learning is doing and doing is learning. That intuitively, that if I watch, let's say I watch a lot of basketball on TV. Am I a great basketball player? No. You have to do it, right? So the same thing here is that if you want to know how to do it, you got to do it on your own. Learning is doing. So it's the same thing.
Not
Right. So you guys hopefully got a chance to take a look at this. All right. So these are all the accounts. And on our income statement, we're going to start out with
Revenues.
yep. So this is money coming in. Whatever it is we do for the business, it doesn't really say here, but whatever we do for the business, this is money we got from our customers, or we earn from our customers. And then we subtract out.
Wages and utilities.
Yep. Good. And that's it. So we would have our net income of 20,250.
250,
20,250? No, 10,000.
10,000. Yeah.
Okay. So this would be the amount that they made. And again, this is kind of intuitive. We just put it in a little more formal way of doing it. Revenues, money coming in, expenses, money going out, what's left over you get to keep. So basically you get to keep 10,250. Okay. Retained earnings. And by the way, feel free to cut and paste any of this stuff, obviously. Feel free to misspell things just like I do. That would fit. No, it doesn't matter. Okay, so retained earnings is 12,500. So this is like the owner's piggy bank. And retained earnings, think about this.
How did you know it was 12,500? Oh, because that's okay. So I'm slow.
So yeah, so this is what they have in the piggy bank. So the owners have earned 12,500 that they haven't taken out of the place. So this is money that came in, but they left it in the business, probably to help finance the business and make the business even more profitable. They left the money in. Okay. And we add in our new net income. 10,250. That is the same income as
And you add cash dividends, right? Declared.
cash dividends go in, but you don't add them. What do you do with them?
You subtract, no, I was saying put it on there too.
Yeah, so the cash dividends, that's the owner actually taking money out of the earnings. So the owner said, okay, I'm going to take some money out, of the business. $1,000 minus $1,000. Okay, so we started out with 12,500 into the piggy bank. We added another 10,000 to the piggy bank, but then we took out 1,000. So the ending retained earnings. What am I doing here? Oopsie daisy. Try that again. Okay, so what is that? 22.
21,750.
So this will be our ending retained earnings. This is how much is in the piggy bank, the owners have in the piggy bank at the end. Put in 10,250, they took out 1,000. And it's left over. Okay, balance sheet. I'm just gonna copy all this stuff down. You don't have to do this. I'm just. What am I doing? I'm just gonna put this down here just so I have the accounts more readily available. Whoa. Okay, that didn't work. Okay, never mind. We'll go back the old way. Okay, so let's see. Assets. We're looking for things that have a value, and the obvious one there is cash. That's not what I want to do. And accounts receivable is the other one. And again, this accounts receivable, this has a future value. The future value is that these people that we did work for, the customers, are going to pay us $20,000 cash in the future. So we count that as an asset. So cash and accounts receivable. Accounts receivable. Oops.
Some accounts payable isn't on there,
Accounts payable is going to be the liability.
and it's a liability because they paid you before you did your service.
It actually is a liability because we haven't paid it yet. We owe them money. We owe
Oh,
them-
because, okay, so they provided you with a good service before you gave them the money.
Exactly. So for instance, a lot of times, like you buy inventory, you buy the inventory, and then the company that sells you it will send you an invoice you have to pay. But until you get the inventory in, you don't pay anything. So when you get the inventory in, then you end up paying them. And so it's a liability. Accounts payable is usually for buying goods, usually. Not always, but and it's when you owe somebody else. So this is sort of, so there's actually two things going on. Accounts payable and accounts receivable are very similar. Receivable means you're going to receive it, and payable means you have to pay it. So
Okay, that
receivable,
makes sense.
yeah. So receivable is when somebody owes us, and a payable is when we owe somebody else. I think this was 20,000, wasn't it? And so this would be, total assets would be. I think that sounds good. Okay, now for liabilities. Accounts payable. So the accounts payable is going to be our liability. We owe somebody $1,250. And that's the only liability we have. Yeah. Okay, so let's see here. So we have, these are the revenues. Okay, and in the equity section, we have common stock. 1,000. And this is the tricky one. I'm just gonna cut and paste it. We take the ending retained earnings. So I think I talked to you guys about this last time. If you come out and your balance sheet doesn't balance, a lot of times it's retained earnings. Because if you put 10,000 or 12,500 in, obviously it's not going to balance. So it has to be the ending retained earnings that we put in. Okay, so total equity is 23,000. 50. And if we add these two together, they come out to 25,000. And again, this just explains how we got these assets. We got 25,000 worth of stuff. How'd you get it? We borrowed 1,250, and the owners kicked in 23,000, and that's how we got it. That's why these two equal. How'd you get this stuff? This side, liabilities and equity, just tells how you got it. Question on that? And yeah, the tricky part here, here's something I want to talk about in this. Notice
Excuse me,
the,
Professor.
yeah,
Sorry for interrupting, but so for number the one we did last class, I didn't have. I like to print it out and write it myself, and I
Yeah.
actually didn't have the printout on me at the time that we were doing it in the last class.
yeah.
So I was just wondering if you post the answers to what would be number 2. I just like to have them just for example.
Yeah, actually, if you go to recorded Zoom meetings,
Oh, okay,
it'll be in there.
okay.
And again, you can just kind of,
Okay,
yeah. So,
thank you.
anyway, what was your profit for the place? The second one is. I got confused for a second there. Okay. Quentin, no, Quentin, go ahead. Yeah, all these videos get posted. You don't have to hang around for it if you know. So all the videos will be posted. Okay. All right. So again, this is the looks good. Okay. So
I have a
let's
question.
yeah.
For the statement of retained earnings, I think it was in the first example. How'd you get the net income for beginning retained earnings? Like I know how you got it, the net income with the revenues and the wages and utilities, but I didn't hear how you got it for like section B.
For this one, yeah. On problem 2, yeah. It just comes from the income statement, the first.
No, not that one.
The one we're doing now.
It was 10,250.
Yeah.
Yeah.
So you're gonna take the 22,000 revenue and subtract out the expenses.
All right. Yeah. So you just slide it over to the next one too. That's the net income for the
Exactly.
beginning. All right.
It's the same income. But by the way, you bring up a good point though. You'll notice that these have to be done in order. The income statement has to come first. Why? You need net income to do the statement of retained earnings. So, if you can't do the statement of retained earnings until you have the income. So you have to do the income statement first, statement of retained earnings second. And you'll also notice you can't do the balance sheet until you have the ending retained earnings. Right? So, another thing I want to caution against, and you get a test or whatever, you jump right in and go, okay, I'm gonna do the balance sheet first, because I know that's the best or whatever, I'm gonna do it first. You can't do the balance sheet until you have the ending retained earnings. Now, I mean, you may logically be able to figure it out. If you know that both sides have to equal 25,000, you may be able to back into that number. But, you know, generally you do these in order. So you do the income statement first, then do the statement of retained earnings, and then do the balance sheet. Because you need the numbers going forward.
I would, yeah, I just had that because there was only like one big number and then you had a net income, so I just didn't know what you added and subtracted.
Yeah. Well, and here's another thing you'll see on financial. I mean, I should pull up. I won't have time in this class, but I should pull up the a real company. It's not uncommon to have a company that'll have one number for revenue and then have 30 things for expenses. So yeah, it you know, it looks a little funny here because of the big space, you know, in between there. But and I could probably close both of these up a little bit. But the
No, that's nothing big. That doesn't. It's no problem.
okay. All right. So let's go down to here, the basic financial statements down here. And we'll go ahead and do this one kind of together. Okay, so this is all the income statement stuff, it looks like. Anything else here? Nope. Okay, so revenues we start out with. So this is money that we earn from our customers. Now, all the rest of the stuff is going to be negative, and there's going to be stuff going out. Cost of goods sold, that's this thing. Leaving the place. Whatever whatever we paid for it, that item is going out. So cost of goods sold. Minus 12. A. Utilities expense. I don't know why the utilities expense they have been so high, but and repair expense. So these are no money going out. Well, these two are money going out, and this one are goods that people have left with. After they paid us, hopefully. All right. $11,960. That we just got. I'll take it by your silence that there's no objections to that. So, all right. So yeah, 11,960 will be the income. We now go to retained earnings. BA retained earnings of 23,000. I'm going to get lazy and just cut and paste this. So our net income goes into our piggy bank, into our retained earnings. Owners took some money out, most likely. So cash is declared. $1,040.
$33,120.
33,120.
Mm-hmm.
Okay, so this is our any retained earnings. So this is what is in the owner's piggy bank after we put in the income that we earned, or the business earned, and then whatever money they took out. Okay, let's see what assets we have. So assets are anything like, well, the accounts payable, this is gonna be a liability. These three, those three look like assets. Oops. So cash, inventory, and equipment. We gotta figure out a better way to have the accounts kind of floating or something. Okay, so 36,800. If anybody has any, a better way of doing this, I'm
51,520.
51,000. What'd you say? 120?
520.
520. Thank you. Okay, so these are the total assets. And accounts payable is 2,300. And that's the only one we have. Is there a mortgage payable? There is a mortgage payable. I'm sorry. Mortgage payable, 11,500. Okay, so the total would be those two together. So we're at 13,800. And again, so these liabilities, the magic word payable is going to automatically be in the liabilities. And most liabilities you'll see are payables. The unearned revenue and stuff like that, you hardly ever see. Well, it depends on the business, but they're not as, it's not as common as payable. So anytime you see payable, liability. Okay. Common stock 4,600. the ending retained earnings. That. So this should be for the 40 or 37, 720. And hopefully, we add these two up. Do you want to? I did something wrong here.
Yeah,
51.
Isn't it just 50, 70, 20?
Yeah, it's 51. Yeah, 520. And again, if you're doing this and it doesn't balance, check the any retained earnings. This is the most common one. With the beginning retained earnings, it's not gonna balance. Okay, so that's it for that handout. Yay! That was our first handout. Okay, now, so here's what we're gonna do next. I'm gonna go through. I'm gonna actually post the assignment right now in Blackboard, and this is where you would submit it. Okay, so let's take a look here. And I'm going to put it in here. Now, you guys can't see anything on yours yet, so if you just take a look at mine right now, and then you'll see it show up. Okay, so submit. So this is, I'm in Blackboard. This is submit handouts and exams to be graded. So we're going to submit this handout. So I'm going to go here. I'm going to click on assignment. And jumbles around. Counting. 403. Oops. Take one handout.
You said it's okay if we wrote it on a notebook paper, right?
Absolutely. You just take pictures of it.
Thank you.
And coming on here, a due date, I usually make these a week out. So this will be due. You know what I'm gonna be doing on the 10th. I'll do it on the 10th. I'll make stuff due on Friday. That makes it easy for everybody. So this is due by next Friday.
You're talking about what the handout we just went over.
Yep.
Okay.
So and again, so if you missed a class or something, and you have to do, you can go ahead and watch the video and catch up, and then enter it in. Now, even if you don't get it in by this time, so this will at this point in time it'll become part of your grade as of the 10th. But it would. My wife just walked in the background. I'm in my basement. So anyway, you can still turn it in and get full credit. It just won't be in your grade, obviously, until you do. So while I do have the due dates, and that's basically the date it'll go into your grade. So if you miss it, you don't get it in that time, you can still get the points for it, and I strongly encourage you to get it in. Okay, points possible 100. All of them. And unlimited attempts, the highest grade. So unlimited attempts, you can put as many as you want. So you can submit, 1 file or 10 files or 50 files. don't submit 50 files, but you can. I mean, so, and if you submit the wrong thing, you can go ahead and submit the right thing. Don't. It's not that big a deal. You know, I can figure it out. I generally go to the last one and look at that one anyway. So if you put in you submit the wrong form or whatever, just submit the right one. I mean, there's not a problem with that. And let's make it available. And I gotta submit this. Okay, now I gotta do something here. So this should be available in your Blackboard now.
Is the one for the definitions in there too?
I didn't put that one in, and that one really isn't. We really didn't do much of it. I guess I could put it in. Well, you know, I don't want to put it in because I don't want people to worry about it. Because you look at it and go, "What do I have to do with it?"
You ain't gotta put it in. Don't worry about it.
Yeah, yeah. So I usually all the stuff we do, but that one I won't. But anyway, so this is where you'll submit it. And again, if you could do it right in the document like I did, because my handwriting is terrible. But do right in hand. If you did it by hand on notebook paper, absolutely fine. Just take pictures of it. If you printed it out, just take pictures of it. The only thing that to avoid, the only thing that when you're turning it in, please don't do these two things. Don't zip all the pictures together. I know it makes sense to zip them and put it in one nice file. Blackboard doesn't like it. So please don't zip them. So if you have 10 pictures, just submit 10 pictures. It makes it a lot quicker. And if you're using Apple stuff, don't put it into a page file. Actually, Apple has the nice thing that I believe instead of putting in the page file, you can convert them into PDF, and that's really nice. So if you put it into a PDF file, that's great. Or, in Apple, if you just submit all the pictures, that's fine too. So, I'll really take it any way that however you do it, however you learn, is fine with me.
What tab do we submit it under?
Oh, under the submit. I hate this color scheme. I'm going to change this color scheme. I won't do it in a second, but it's under submit handouts and exams be graded.
Okay, yeah, I'm looking at Blackboard right now. It hasn't came through yet, so.
Oh, it has.
You gotta hit that
You didn't
like
refresh it.
refresh button on the green tab.
Okay, thank you.
Yeah, sorry about that. Yeah, and so yeah, I don't know who comes with these color schemes, but it's light pink on white. I think actually this. I think.
Question. If I did it on notebook paper, so am I just submitting the 3 problems that we did? Like I'm not because I know.
That's exactly it. Yeah.
Okay.
Yep. Yeah. If you do a notebook paper, you don't have to. I know this is. There you go.
God.
Isn't that fun? That's fun. Yeah, so this is the
Soccer theme.
soccer team is actually the one I found out that you can actually see it. So anyway, yeah, so if you go to submit handouts and exams to be graded, this is where you're going to put it in. And we have the chapter 1 handout. We're gonna have the chapter 1 practice exam. Also, your exam when I send out the exams, you're gonna submit it in the same place. Yeah. Any question on that? And if we click on it, it'll tell you the due date. If I and just attach the files to it. Okay. Well, I kept you 2 minutes too long. I give you 2 minutes. I'll make it up next class. Any questions on any of this? Okay. All right. Well, no homework. Just turn this in. Next class we'll start in on the practice exam, and we may do a problem. If we do, we'll do it together. I'll have that class. Any questions on anything? Okay.
But I got a question.
Sure.
So for the first one, like when it says the generate counts balances, well, equipment, would that be in the like account statement, assets? Like where would that be at?
Assets. Here, let me go ahead and share my screen. Yep. So equipment as a value be in the assets. Any other questions? Okay. Well, I will see you guys next week. I'll leave this up for a little while. Anyone else has any questions on it? But yeah, so I'll see you guys next week and on Tuesday, and enjoy your weekend.
Thank you.
See you guys.
Thanks.
Thanks.
Thank you.
Good day.
I also had a question. So we're gonna do like because this is homework, right? And we're gonna turn it in. We get credit. Is the
Yeah.
homework always gonna be like bank statements?
No. This is just the first topics of the financial statements. Just to give you a heads up, the next chapter is chapter 2, and that's going to be what they call journal entries. So there'll be other things, that we go through. And this is kind of like the financial statements are sort of like the end of the process. This is what you do at the end of the year to see how much money you make. How much money did we make for 2020 or whatever it is. So this is sort of like at the end of the period. And so we're going to now figure out how we get these numbers, how do you get these revenue numbers, these expense numbers and all that. That's what's going to be in chapter 2. So it'll be different than this. But this kind of goes through all of accounting, these, especially the income statement and the balance sheet. It's a recurring theme.
Okay, thank you.
You're welcome. Okay, well. Sign off.